In July 2022, Vanguard came out with their Advisors Alpha study, which basically says when you should work with an advisor and when you should not work with an advisor. And I agree with a lot of the points here, and I want to walk you through it so that you can determine if it does or does not make sense for you to work with an advisor. Now, that's probably pretty weird coming from a financial advisor. And yes, I often tell people, I don't think you should work with an advisor. And they'll say, that's odd, you're an advisor. I go, yeah, but it just comes down to timing of your life. For example, if you're 40 years old and you have a 401k with $500,000 in it, the reality is you can get assistance from an advisor to help you buy a new home, help you save on taxes, should you do Roth 401k, traditional 401k. But once you've got through most of that, most people go, okay, I'm set up. At this point, I understand I should save this amount to this account. I should make sure that I save enough money so if, God forbid, something happens, I have an emergency fund covered. Once you have the basics down, it's now about making sure you actually do that, which is not easy, but it's simple. It's saying, I'm going to save this amount of money. I know I'm on track for retirement. If I want to retire by X age, if I want to retire early, like the strategies I talk about, I know I need to make sure I also have my superhero account or all those things I discuss. The difference is when you're actually 1 to 3 years out from retirement, that's where it can make a lot of sense to work with an advisor because they can often protect against something that may have caused you to work a few more years. And that could be as simple as shifting your investments. It can be developing a tax strategy. It can be getting an estate plan. And then ultimately, it's that peace of mind, knowing no matter what, you have someone in your corner as a partner to help you out. So the reason I want to highlight the Vanguard study is Vanguard is a company I really like. And for a lot of people, they'll reach out and say, yeah, I'm ready to start working with you. And I'll go, look, it's just too early. And they go, what do you mean? I go, at this point, I need you saving and investing to your 401k. I don't think it makes sense to hire us quite yet. Vanguard's a company, it's super low cost, they've got some good investments, go there. And they'll go there for a little bit, but I don't want to just say that, which is why I, of course, created, as many of you know, the Early Retirement Academy. Now, this is kind of that middle ground, so I'm going to explain it, and I'm going to go through the study today. I wasn't getting yelled at because many people aren't mean enough to yell at me, but they were like, hey, why are you referring me to this other advisor? Because for a long time, I would say, look, I don't think it makes sense to work with us yet, but if you want help, you can pay this hourly advisor from this network and hopefully they can help you out. And they'll come back to me and go, look, they told me what a Roth IRA is, but not like how much I should do. And they didn't tell me if I should convert money to Roth. And they didn't tell me exactly what my withdrawal strategy is. And they didn't tell me XYZ. And I'll go, huh. So what I did is I created this academy that you can now see on my screen here. Now this is a course and it's $300 for a reason. There's no one-on-one guidance, but you do get access to the software that I talk about in my videos. And at the same time, you can see this is really good if you want to be your own advisor because I walk you through Monte Carlo, Social Security, long-term care, insurance, pretty much everything you need to know before you really retire. So you're like, okay, there's nothing I missed. So for some people, they go, this is great. This is exactly what I need up until I'm now at a spot where I want to work with Root. Because once again, there's a few levers you move and it'll look like you have 10 million more dollars and then 10 million fewer dollars. So that is why we're going to talk about the importance of an advisor and specifically the timing as to when it makes sense. Now, if you don't already know, my name is Taublieb. I'm a certified financial planner and I'm the host of the Early Retirement Podcast. I work at Root. You can see the microphone was covering this, but Root, we do human planning, which really means we take you first, and the quality of a good financial plan is how well are you sleeping? Not the quality, the sign. That is what I care about. So I'm going to walk you through this Vanguard study. Let's have some fun. So you can see it on my screen, but you can also go ahead in the description of this episode. I'm going to link it so if you want to read it. Now, it's about 30 pages long, so no need to read all of it. I'm going to summarize it for you today, but once again, if you want it, it is below. Here's the main gist. What they're saying is we believe if you implement Vanguard's Advisor Alpha framework, which we'll talk about, it can add up to or even exceed 3% in net returns for your clients. So what does that really mean? If you're going to pay an advisor 1% per year, Vanguard is saying you can get returns in excess of that by 3%. So that's kind of a no-brainer. I'm happy to pay someone 1% to get 3%. My parents were burned by 4 financial advisors. You can listen to the whole story right here if that's of interest to you. But I am the first person to go, look, yeah, I get that there's value to hiring an advisor, but it's about timing, because my parents were given some advice that, let's just say, was less than optimal regarding annuities, regarding insurance products, regarding things they just shouldn't have purchased, because it was on the back end, which they did not know, giving their advisor a big commission and actually limiting their growth. And so what the advisor did, in my opinion, is they really were going to people that were uneducated on the financial side, saying, look, what if markets could never go down below 10%? Wouldn't that feel great? And my parents were like, that's amazing. I mean, I'm scared. I don't want my markets money to go down, and markets scare me. When in reality, some more education, understanding markets do go up and down, and over the long term, they go up, would have gone a long way. So it's one of those things that when you're getting the right advisor, yes, that trust thing is important, which is why I tell people, like, listen to these videos for not a year, but a long time, so that you can really understand, do we even speak that language? Are we the right fit for you? But that net returns, I really don't like when advisors will say, look, I believe I can beat the market by 5%, so you pay me 1%, and then we have a good thing going here. The reason I don't like that is because what happens when markets don't do well, but your advisor also underperforms that? Well, you're going to go, hey, advisor, I was paying you to outperform, and now you're not even doing that. So not only do I owe you your fee, but I also lost money versus just what the S&P 500 has done. And that's the reality with a lot of advisors out there, is they're going to be pushing, not all of them, but they're going to be pushing performance. That's not my belief. And it's also not Vanguard's belief. Look at this. Now, as a reminder, everything I talk about is for fun, educational, informational purposes only. Please be smart about this. Consult your financial advisor, tax preparer, estate attorney before executing anything here. There's one key line here I want to point out, and then I'm going to show you those exact statistics. They say value is a subjective assessment that varies from individual to individual. My mom sleeps great knowing there's someone watching her money so that she can't screw it up. I have a friend that goes, I would feel more anxiety having an advisor because I want to control the money, and I feel like I'm going to pay attention closer than they would because they have 1,000 clients. So the value for some is peace of mind, for some it's financial, for some it's both. Now here's where Vanguard comes up with it. So the first one of their 7 modules here, what's the benefit of working with an advisor, is number 1, suitable asset allocation. I see this one often. So I have people that reach out, they've got 60-40, meaning 60% equities, 40% bonds, because they think that's optimal. The reality is, if we have Social Security or a pension or rental income, you can take on way more risk in your portfolio. You don't need to, but you could. And the story I'll tell, and the reason for this, is I have a client that's 83. They have 100% equities. And they were like, isn't that bad? Like, shouldn't I be way more conservative considering I need this money to live? I go, absolutely. How much money do you need to live? And they go, about $10,000 a month. And I said, how much does your pension bring in? They said about $12,000 a month. I said, if your $3 million went to zero, I would not get invited to Thanksgiving, but you would be okay. So the difference is that person can have 100% equities if they want to optimize and the growth and the volatility doesn't bother them. Other people, they couldn't have anywhere near 70% equities because the last thing you want is markets to go down and have to sell at a loss. So just dialing in that asset allocation, you can see here, typical value add, they're putting kind of greater than zero, meaning kind of hard to quantify. The next one is what's called cost-effective implementation. That's essentially the fees of the investments. So the tricky thing about our industry is there's a lot of fees out there. Now I break it down so it's super simple, which is there's the advisory fee, that's what you pay the advisor. There's the cost of the investment you own. So the expense ratio is what's the actual cost of what you pay for. For example, there's a Vanguard fund I own. The cost of that is 0.05%. So that's a cost that I pay. Bill Gates pays if he were to own that. You would pay it if you were to own that fund. Now, that's not bad. We want that to be an option for us. It's almost like saying you could, instead of paying that, you could go buy 3,000 stocks, but that's like checking out at the grocery store with 3,000 grains of rice. Shouldn't we pay like a little premium to get a bag to hold all of that rice? That's what you're paying for. So we don't need to pay for the best, fanciest bag. We just need it to hold our rice. Not a perfect analogy, but I try to keep it fun for my clients. You can see about 30 basis points is what they're saying, the value. So basis points, the easiest way I tell some of my clients, just put a dot in front of it. Don't need to make it more complex than it needs to be. 0.30. Rebalancing. Well, I give this fun story here, and not all of these stories are from Vanguard. I'm just walking you through it and giving you my insight. Is I will train a lot of advisors. So people reach out to want to work with Root, and I will be involved in some extent to the training and process as to how they work with our clients. So here's the first question I'll ask. I'll say, what's your rebalancing tactic? And they'll say, I rebalance quarterly. I go, cool. What if markets don't change at all? Nothing happens. What would you do? They go, well, I rebalance quarterly. That's what I do. I go, what if markets are super volatile in 1 week? What do you do then? They go, I rebalance quarterly. I go, why? Wouldn't you rebalance way more when markets are volatile so you get to the optimal mix? And then why would you rebalance at all when markets haven't changed? And they've just been taught in a system to rebalance quarterly or biannually or every year. The reality is it should be customized. And you can see here, their rebalancing approach adds 14 basis points according to their study. The next one, and this is a big one, behavioral coaching. You can see it says about 0 to 200 basis points. The reason that they're saying that is the behavioral coaching side, there's a lot of people that are holding a mortgage and they're paying extra down to the principal because it feels better. There's a momentum to that. They love seeing the balance go down. But the reality is if they invested a lot differently outside of that and just paid the minimum, that could be a big difference. I mean, hundreds of thousands of dollars over time. The other one is behavioral coaching. The reason I imagine this study says this amount of value is there becomes a point where, what if I told you you could retire earlier and it just means you're spending a little bit less money, and you were like, well, I'd rather retire 5 years earlier and spend $7,500 a month instead of $8,000 a month. Like, that's a trade-off I'm willing to take. Well, good luck quantifying that. You just got more time with friends and family and peace of mind, which maybe you never would have considered. This is a big one. I love this one. It's called asset location, not asset allocation. That's different. So asset location, you can see they say 0 to 60 basis points. What that's saying is let's assume you have a total 60% equities, 40% fixed income, bonds, cash, things like that. Most people will put 60-40 because that's their mix in every account. So Roth IRA, 60-40, 401k, 60-40, and so on. That's not optimal. The optimal way to do it, if you want a 60-40 mix, is have 100% of your Roth IRA in equities. We're not touching that for a long time. And then maybe we have 40% fixed income in your 401k. Now, that sounds way too conservative, but that's just kind of me giving you the philosophy is if we want an overall mix to represent 60-40, what we need to do is invest in every single account so it comes to that overall mix rather than taking 60-40 and putting it everywhere. That makes a big difference because if you have your Roth IRA maximum growth, well, it's going to make you way more money. So if any of you guys have a Roth right now and you're watching this video, if it is not 100% equities, you probably want to look into changing that. This is another really big one I like, spending strategy. This is huge. You can see I have a video here where I talk about withdrawal strategy and the way to think about withdrawals, which I think is one of the biggest factors when it comes to retirement planning, which is where are you going to pull income from? How are you going to pull it? And what's the tax strategy? That you can see adds 0 to 120 basis points. And then the last one here, they say total return versus income investing. This is a really big myth in our industry where people love dividends. But let's take a step back and think, what is a dividend? Well, a dividend is a company paying you essentially to say thank you for owning the company. So if I invest in Apple and Apple pays me a dividend, I like Apple because they're giving me a dividend. But if I'm a really intelligent investor, I'm thinking, well, what if Apple did not pay me that dividend or all the other millions of people investing in Apple and instead invested it back in Apple to make a better phone or a better computer, which might sell way more, which might actually yield me a better return. So when you're in retirement, dividend investing makes a lot of sense. You're living off the income. You want it to be throwing off dividends. When you're leading up to retirement, you don't want to prioritize dividends. You want to prioritize total return. So the way I'll explain it is like real estate. If you have what's called a 4% return on capital, meaning income that comes from a rental property. Let's assume, for example, you have a property worth $100,000, which there's not many worth that amount, but just keep it easy. And it brings in $4,000 a year after expenses, after taxes. Just keep it simple. Well, that's 4% that you're receiving in income. But maybe it also went up in value from $100,000 to $102,000. Well, 4% is the income you got, $4,000, and it went up by 2,000, so now we're at 6. So 6% is your total return. That's what we want to know. If a company pays you a dividend, and let's assume it's 1%, and it goes up by 4%, that's 5% total return. I would rather a company pay me 0% dividend, but grow by 12% because I'll make way more money. So just the coaching around some of these things can go a long way. I'm going to fast forward to the conclusion here, but this is an amazing paper that I certainly encourage you to read if you're considering to hire an advisor. And they say putting a value on your value is as subjective and unique as each individual investor. For some, the value of working with an advisor is peace of mind. For others, we found that working with an advisor can add up to or even exceed 3% in net returns, of course, assuming Vanguard's framework, particularly for taxable investors. This increase should not be viewed as an annual value add, but is likely to be intermittent. So what that means is there's times where I'll encourage clients, I need you to spend more. Markets are doing really well. Other times I'll say, I need you to spend less and do this tax strategy. It's a completely dynamic approach, and that's to me how success works. So once again, if you are currently going, I want to be educated, I want to be my own advisor, I like what I'm hearing today, start with the software, start with the course, that academy. That might be good enough for you to start. If after that you determine, I still want ongoing guidance, that's why we exist. And you can, of course, apply to work with us below with that link. And I'll see you guys next time.